Australia is often regarded as the lucky country, owing to its seeming ability to beat every major recession. However, Australia's luck might be about to run out. Its GDP growth came in at an underwhelming 0.2% quarter-on-quarter, slightly below expectations of 0.3% quarter-on-quarter. Furthermore, GDP only grew 2.3% year-on-year, versus expectations of 2.4%. Now, while this was only a small miss, those expectations were already incredibly low. Basically, Australia's expectations had been lowered, and then Australia's GDP failed to meet even those lower expectations. Matters also might be even worse, because inflation has remained stubbornly high. The latest monthly reading put CPI inflation at 6.8% year-on-year. The latest quarterly reading was at 7% year-on-year. Inflation is similarly well above the Reserve Bank of Australia's target of 2 to 3%. This has of course caused the RBA to continue to increase interest rates. Recently, it increased interest rates by another 25 basis points, taking the cash rate to 4.1%, and the RBA has signaled that further cash rate increases might be on the horizon. The RBA has also indicated this could be on the back of stubbornly high wage growth in some sectors. For example, the minimum wage went up 8.6%, and the award wage, which causes many employees in Australia, went up 5.75%. Now, that 8.6% is above inflation, suggesting this could potentially trigger a bit of a wage price spiral, particularly if that is not coupled with productivity increases, something that the RBA has been at pains to note. They've specifically noted that Australia's productivity has been stubbornly low and has been declining. The amount of GDP per hour, that is the outputs produced per hour, has been decreasing. And this suggests we've got higher wages, higher inflation, and declining productivity. Now, of course, workers are basically saying, well, why would I be more productive if you're not going to pay me more money in inflation-adjusted terms? After all, for people not on the minimum wage, well, their real wages have actually gone down. For perhaps white-collar workers or highly skilled workers, in inflation-adjusted terms, their wages have decreased. Therefore, they're less likely to go above and beyond, so to speak, and less likely to work more and more hours. Therefore, you end up with this GDP per hour decreasing. The reason for that is in the past, someone might have been employed for, say, 35 hours officially, but they might have actually worked 50 hours. So the official hour reading in GDP per hour is 35 hours, but they're really producing the outputs accruing from 50 hours of work. Hence why GDP per hour might look rather high. However, when real wages are going down, people might not do those extra unpaid hours. They might only work the 35 hours they're actually employed to work. Therefore, you're going to end up with the GDP in the numerator actually decreasing in the GDP per hour equation. Not only that, many Australians are seemingly picking up a second job, and this is showing up in the data. Now, this, of course, will feed into the productivity data as well, because now the official number of hours worked will increase, but also at those second jobs that people are working, they're often a little bit less productive. This might be because they're not as skilled in that second job, or maybe that second job is a little bit more junior, it's a little bit more menial, and therefore the actual amount of output in a GDP perspective per hour will decrease at that second job. As a result, you end up with lower productivity. But when Australians are also taking on these second jobs, it also ends up with a rather tight labour market, with the unemployment rate coming in at 3.6 to 3.7%, which is really quite tight. The RBA, therefore, is in a little bit of a bind. They've got a tight labour market. They've got, in some sectors, particularly minimum wages, higher wages going up, but not so much in the white-collar workers or the skilled employees. Furthermore, productivity seems to be rather languishing, and GDP growth itself is not doing particularly well. This means the RBA has a little bit of a problem trying to resolve what's going on with the economy, and creates the risk that the RBA will hike rates rather too much, triggering a potential recession, triggering that GDP growth to go into negative territory, potentially for 2 consecutive quarters, thereby ending Australia's run of luck. Now, of course, the question is what might happen going forward, and here we are really crystal ball gazing. However, there are things we need to be cautious of. For example, like I indicated, productivity is relatively languishing, and it doesn't appear to be actually increasing anytime soon, because many workers simply realize they're not actually going to get any upside for working more hours or working more unpaid hours, so they simply don't because they won't get promoted or they won't get a raise. Furthermore, if we look at what's happening with China, well, China's economic growth has been a little bit underwhelming. While China's reopening has been good news, it hasn't gone quite as rapidly and it hasn't generated quite as much growth as would have been ideal. For example, China's exports have been underwhelming recently, undershooting expectations. And as a result, you're seeing China's economy growing perhaps less rapidly than maybe people had expected. And this therefore is bad news for Australia's resource-rich economy, which has in large part relied on trade with China. This suggests that Australia's economic growth might be heading into a rather mediocre stage. Even if Australia doesn't go into a recession, it certainly is going to face slower growth going forward. Potentially slower growth, higher inflation, and higher interest rates for the time being. Now, of course, the RBA might make this worse. If the RBA keeps hiking rates, keeps hiking them by another couple of 25 basis points, so taking them up to 4.85%, for example, as some have mooted, then in that case, we could easily end up in recession territory. And the reason for this is corporate growth will decline significantly because corporations won't be able to go out and borrow, and also they're facing higher minimum wages, so they're going to be able to afford less. Furthermore, many mortgage holders, well, they're going to be going off their fixed rate mortgage relatively soon, and therefore we're facing significantly higher variable rate mortgages, potentially significantly crunching consumer expenditure, thereby harming economic growth. So if the RBA is not careful, Australia's economic growth could dip into negative territory. Now, of course, this suggests that Australia's economy is in for a rather rough ride, and Australia's luck might potentially be running out. As for whether Australia enters into a recession, well, again, that remains to be seen. However, there is a non-trivial risk of that actually occurring, given what we're seeing with the GDP growth data, with the inflation data, with the RBA's objective function to get inflation back down toward target, even though economic growth is tanking, and given what is happening with China. And therefore, Australia's growth could start to decline. The question then is, how might you invest around this? Because obviously investing around a situation where there's a possibility of a recession, well, that is incredibly fraught. One has to wonder, well, do you remain invested? Do you just sit in cash? What do you do? Well, really, there isn't a great answer. Oftentimes, the goal is to generally diversify so that you can mitigate some of that risk, so that you can mitigate the idiosyncratic risk that might occur in the event of perhaps an interest rate increase adversely affecting one of your portfolio companies. However, there are some general rules you want to look out for when trying to select which stocks are worth investing in. And if you're not entirely sure which to invest in, you'd obviously want to get professional help with doing that. But of course, things to look out for are selecting companies that have a decent moat that gives them a degree of market power, and this market power therefore enables them to better weather a market downturn. It better enables them to perhaps muddle through a negative GDP growth cycle, thereby coming out stronger on the other end. Furthermore, look for companies that have pricing power. Pricing power both in respect of their customers and their suppliers. So that if you've got stubbornly high inflation, those companies are able to perhaps resist some of the price increases from their suppliers, and also can pass on the price increases to their customers, thereby mitigating that problem. You'd also be looking for companies that have already done a lot of their capital expenditure. This is really for two reasons. One, higher inflation has built up costs for these companies. Therefore, you want these companies to have already spent that money before you're investing, ideally. And then secondly, if interest rates are stubbornly high, well, these companies are going to face higher cost of capital if they're going to go out and do capital expenditure that's needed. Therefore, it could perhaps be more even costly. And as a result, you want to look for these companies that have already done a lot of that expenditure. So look for companies that have a moat, look for companies that have market pricing power, and look for companies that have already spent a lot of the money that they need to spend. Furthermore, you'd be looking for companies that have a decent upside. One way to look at this is by looking at analyst forecasts, looking for companies that analysts think are going to have some upside over the next 12 months. I focus on the 12 months or so because that's where you get a capital gains tax discount if you've held it for more than 12 months. So for example, you might look at companies that analysts are giving more than 10% upside over the next year, and those companies that also have a decent dividend yield. And the reason you look at both is that obviously analyst upside is not perfect, but it suggests to you that maybe analysts who are professionals in this space at least see some green shoots with that company. Furthermore, the dividend yield signals a couple of things. Firstly, companies that have a higher dividend yield are generally safer on average, but of course there are exceptions. Furthermore, dividends often attract franking credits in Australia, thereby giving you a bit of a tax advantage from investing in these. The question, of course, is how would you get access to these analyst forecasts? Well, one way is to subscribe to a platform like Simply Wall Street, which has analyst forecasts for earnings per share and stock prices for myriad companies. If you sign up using my link in the description below, you can get a rather hefty discount. Or alternatively, premium subscribers to my own newsletter or subscribers to my membership program, well, they can get access to analyst forecasts on a roughly monthly basis for the ASX 200 and the S&P 500. And these can form at least some inputs into your decision-making framework. Obviously, you don't want to blindly rely just on analysts, but they are one aspect that can go into your broader decision-making framework, in addition to considering what's in your existing portfolio, your risk aversion, and what you think about a particular company, in addition to what analysts are saying. They can form one part of your broader decision-making mosaic, and you can sign up for that using my link in the description below. But in any case, Australia's economy seems to be heading for a slightly rougher period on the back of higher inflation, lower GDP growth, and higher interest rates. And this therefore suggests you need to be very careful about which stocks you are selecting for your portfolio, and particularly paying attention to which stocks have A, decent upside, and B, have some decent position in the market, so they're able to weather an economic storm. In any case, if you've got any thoughts about Australia's GDP or what's going on with it, let me know that in the comments below. And always, thanks so much for tuning in. Don't forget to subscribe, and hopefully I see you next time as well.